Welcome to the Practitioner's Brief. This is John Cervantes. This is our second episode designed to help simplify financial markets. If you watched last month, you'll notice the wife spruced up the spot. Got some lights, got everything organized, got some knickknacks on the shelf, got our Texas pennant up. She got rid of my Normatec boots. So we're set. This month, we're talking about equity market rotation because that's what bull markets do, is that they rotate. Your laggards tend to catch up to your leaders. It's typically not the other way around, and that's exactly what we saw in the month of August. Generally strong performance in equity markets all around, but big catch-up trade in small caps up almost 7%, developed international stocks up 4.5%. And some significant divides between AI capital expenditure approaches. Apple up almost 12% on the month, who has more of a wait-and-see approach to AI or wait-and-partner. And Microsoft, who's all in, down 5% on the month. And so you saw this big rotation happen in the month of August. And I think there was two notable events leading to a third unrelated. But OpenAI launched ChatGPT-5, kind of a dud, not really an evolutionary step forward, just some incremental progress. And then the Nanda project over at MIT published their State of AI in Business 2025 report. And this was kind of making the rounds in the press. And there's a couple of key quotes that I took away from this report. One was, it found that despite 30 to 40 billion in enterprise investment into Gen AI, 95% of organizations are getting zero return. And the core barrier to scaling is not infrastructure, regulation, or talent. It is learning. Most Gen AI systems do not retain feedback, adapt to context, and improve over time. So this is pretty damning publication coming out of MIT. And I think it's just symbolic of just where we are in this AI cycle. You're having a lot of spend without a lot of results. I think it's just going to take time. These corporations are really good at making a lot of money with as few inputs as possible. They're going to find a way to leverage this technology. It's just going to take some time. And despite some of this negative press, the bull market pressed forward, and that's what it does. It overcomes counter narratives and continues to make some progress. And the rotation is a healthy sign to a bull market. The third key event in the month of August was Jerome Powell's speech at Jackson Hole. This is a highly anticipated speech where the Federal Reserve tends to give insights into their policymaking framework. And the market's takeaway from this speech was that they're going to begin cutting interest rates in the month of September. Now, there's some key data points that need to come in the favor of cutting interest rates between now and then. Most importantly, the jobs report's on September 5th. If that jobs report is ho-hum or a little weak, that's going to reinforce the case for an interest rate cut. If the jobs report is strong, it could cause the Fed a big headache as to what they're going to do in that meeting. And so it's going to be a highly anticipated meeting in the month of September. That could lead to some volatility in financial markets. So this is a meeting that we're going to be highly attuned to. I had a few points for strategy this month, and I'm going to highlight two of them. The first one being growth rates between the Magnificent Seven earnings and the S&P 493 are beginning to converge. They're expected to reach parity in 2026. So we have to ask, especially for incremental capital, why continue to take the concentration risk? Or maybe a more positive spin on it is, what opportunities lie in that S&P 493? And I really been harping on this. I'm going to continue to harp on it until the evidence kind of changes. The opportunity set to me is much more attractive in that S&P 493, and it's deserving of additional attention. Second point I wanted to highlight was small cap exposure. Most investors typically get their small cap exposure through some sort of index, S&P 600 or the Russell 2000. So those indexes have extremely different construction methodologies. And as an investor, I think you have to ask, why do you own it? And how much do you own? And I think those are questions that investors aren't asking frequently enough. And because if you have a structural view on small caps, a higher quality index like the S&P 600 could be a better choice. If your view is more tactical, you want that pure unadulterated small cap exposure, the Russell 2000 could be a better choice. But I think investors don't spend enough time analyzing these decisions, and I think it's important to question why. Do you even need to own them to begin with? Maybe not. Jeremy Siegel, professor at Wharton School of Business, he he contributes the historical premium or outperformance that small caps have endured is really driven by one key time period from 1975 to 1983, where small caps really posted some significant performance over large caps. He furthers that it's really due to some legislative changes that occurred in 1974. You kind of had the blow up after the Nifty 50. Money was seeking some new opportunities, and that kind of drove, according to him, a lot of this outperformance. And so for me, blindly allocating capital to an index, because that has just what has been done historically, it just lacks intellectual rigor. And it's okay to question why you own something and how you're getting that exposure. Um, for me, who focuses mostly on individual securities, I love searching for opportunities in that $1 to $25 billion space. That's where businesses are really starting to reach that escape velocity. But it's not a mandatory allocation. And I think, I see these pie chart type portfolios where investors have high single digits to low double digit percentages between small and mid cap exposure, mostly through indexes. And those have largely underperformed. They've underperformed for some time. And so I think questioning, what is my allocation, tactical or is it structural? And then how am I getting that exposure, and what's my view on it? These are all important questions to be asking, and they deserve more consideration. For planning this month, I really wanted to highlight private markets and really offer some words of caution. They're not a panacea. Um, Enhanced due diligence is required. And what really motivated this piece was an article from CNBC titled "When Invest Like the 1% Fails." It highlighted some recent losses investors were having on some real estate funds, and I think real estate more broadly has struggled, but the private markets offer their own unique challenges, and I think investors sometimes can get misaligned with their expectations and just the structural realities that come with these type of investments. And as a reminder, the category is very broad. It's venture capital and private equity and private credit, real estate. There's a bunch of other subcategories, and there's this view that private markets are going to be better returns. It's going to be less volatile. Um, but a lot of that comes with, there's a lot of nuance, a lot of gray area, and a lot of partial truths. And it's important that investors are really doing their due diligence. And even better is having fiduciary advice over those private market investments. So really, it's just a word of caution that if you're being advertised private market investments online, like, you're not being let in, you're being sold. And so it's important to understand these kind of nuances when dealing in these types of markets. Going forward, I'm planning to do a deep dive on the private market space in general to help investors parse through how they work, what considerations they need to have when deciding what to investing in the space in general. So that hopefully will come out later in September. As far as other topics, shoot me a note. If there's another topic that you think I should cover, please let me know, and see if we can't put something together. To wrap up, if you want to discuss your portfolio or have any questions about today's topics, book a strategy call. My contact information is below. If you also find this information valuable, please share it. Thanks for watching.